This is Debt Free in 30, where every week we talk to industry experts about debt, money, and personal finance. Here's your host, Doug Hoyes.
On Monday, October 3rd, Finance Minister Bill Morneau announced big changes to Canada's mortgage lending rules. Real estate agents, mortgage brokers, real estate lawyers, they're all in a panic, worried that these new rules, scheduled to come into effect on October 17th, will prevent many real estate deals already pre-approved from closing, and that it will kill the real estate market. So, is the sky falling? Will the new mortgage rules hurt the real estate market? That's our topic today here on Debt Free in 30. To discuss it, I'm joined by my Hoyes Michaelis co-founder and business partner and fellow chartered accountant and licensed insolvency trustee, Ted Michaelis.
Chartered professional accountant.
Oh, that's right. We got I'm just bound and determined to continue using the old name. So, Ted, is the sky falling?
All right, well, let's start by looking at what the new rules say. All insured mortgages, so anyone that's requiring CMHC or Genworth or any of those other insurance products for mortgages, are going to now undergo a stress test. Previously, the stress test was only applied to variable rate mortgages and for people borrowing with fixed terms under 5 years. So now it basically covers anyone who is putting down less than 20% when they buy a home.
And that could be a significant number. I mean, Genworth, which is one of the other insurers, like you said, CMHC being the biggest one, but Genworth is pretty big as well, says that more than 1/3 of mortgage borrowers would struggle to meet the new rules.
I can believe that.
I mean, that's a huge number. So, I mean, we know that in late 2015, the Bank of Canada reported that 8% of Canadian households have a debt-to-income ratio of more than 350% of their gross income. And that's double the rate going into the 2008 recession. So we're in trouble. I mean, that sounds like a big problem to me.
Well, and the only way people have been getting away with that is because interest rates are so low. But let's tie this back to some information from our own practice. We know that 1 in 4 of our clients own a home at the time they declare themselves to be insolvent, with an outstanding mortgage on average of about $200,000. These aren't average people and average mortgages, but the thing to keep in mind is the average insolvent person has financed their home at a ratio of 90%. In other words, 90% of the net value of their house is tied up as a mortgage.
So these are obviously high ratio mortgages. So if 1/3 of mortgages and the people who borrow those mortgages would struggle to meet the new rules, that means 1/3 would obviously struggle if interest rates go up. So,
that's right.
So that's a big deal. So, okay. So when do these new rules come into effect?
So effective October the 17th, which is what, a week and a half from now?
Yeah, not too far into the future. So, and the way this stress test works then is it's not based on the actual rate you're paying.
No, it's based on the greater of the contract rate for the mortgage or the Bank of Canada's conventional 5-year fixed posted rate.
Okay, that's a big mouthful.
That's a made-up number anyway. So what the Bank of Canada does is they post the average 5-year rate, fixed rate from the banks, and they call that their the 5-year fixed posted rate. Right now, that's somewhere around 5%.
Yeah, 4.64% as we're recording this, but obviously it could change. So the Bank of Canada does a survey of the big banks, and they're not taking actual real rates.
No, and they're certainly not taking the best rate. So, if you're a customer that's been with them for years and you ask for half a point off, they'll probably give it to you.
So I go to the bank's website and it says the rate is 5%, but if I go in there, it might be, 4.5 or 4 or something like that.
Particularly if you tell them you've talked to 3 other lenders and they want your business.
So the Bank of Canada is using the high number, which isn't really a real number. So they've in effect inflated how this is going to work. So
exactly.
Now I went online and pulled up one of the banks to see what I would qualify for.
And they said no.
But if I had better credit, then a 5-year variable rate at this particular bank was 2.7%. So I could go in there, assuming I've got decent enough credit, qualify based on that 2.7%. But under the new rules, I would have to qualify at a rate of 4.64%. So that's going to be making it a lot more difficult to qualify. So
that's a huge difference to your monthly payment.
Well, so give me some numbers then. What kind of mortgage could I qualify under the old rules and under the new rules?
Well, so I'm not going to do the math myself. We went onto Rate Hub. It's a website on the net, obviously. And here's an example for you. A household with $100,000 in income and a $40,000 down payment would qualify for a home worth $665,000 using today's best rates. So in other words, they qualify for a mortgage of $625,000. But under the new rules, subject to that stress test at, the 5% interest, they only qualify for a house worth $505,000. So that means the house is worth $465,000.
Well, that's a huge difference. You're talking $150,000 difference or whatever that is, more than that.
Huge. Yep, that's right.
So huge. So under the old rules, I could get a house for, $650,000, $700,000. Under the new rules, it's, $500,000 or something in that range. So what do you think that's going to do to house prices?
Well, it's got to have an impact on, first, the starter homes. So the folks that this affects most dramatically are the people getting into homes for the first time, because they're almost invariably going to be the ones with insured mortgages. So now, instead of looking at the 2-bedroom detached bungalow or whatever it is they were looking at, they're going to be having to go down at least one full category. Could be a whole different neighborhood, but it impacts in so many different ways.
Yeah, it could be really significant. Now, the other big worry is that there are lots of home buyers who got pre-approved for a mortgage. This might have been a month or two ago, and they were, they've already purchased the house or the condo or whatever, but the deal hasn't closed yet. And now there are these new rules. So how's this going to muck things up?
Yeah, for the next couple of weeks, things are going to be crazy. So what the government has said is that the new rules aren't going to apply to any signed contracts that were dated before, I think it's October 3rd. So anybody who's got a legally binding agreement to purchase a home, under the new rules, they got pre-approval, they're probably okay as long as the closing date is before March the 1st of next year. And so that means if you're already in a real estate deal, you've been pre-approved, you've got the mortgage insurance coming, you're probably okay. The rule also says that any deals that get penned between now and October 17th will be okay. So as long as the contract is binding by October the 17th and the closing date is before March the 1st of next year, then the new rules don't apply. For everybody else or anything else, the new rules will apply. So if you sign an offer this week, but you don't make it legally binding and firm by October 17th, then you've got to qualify at that higher rate. You've got to meet the stress test that they're imposing.
And what we're telling you is what we've read from the finance website.
That's right. We took this from the information that the government has published. The specific details will be made available to mortgage brokers and lenders very quickly. But this is what they want people to understand. You've got to get the deal done. Well, if the deal's already in place, you're okay. If you get the deal firmly signed and committed by October 17th, you're okay. After that, the stress test will apply, and so you've got to be prepared to get approved for a lower mortgage or significantly higher payments on the mortgage you thought you were going to get.
Yeah, and nothing we say on this show should be construed as legal or other advice, because these rules are obviously brand new. They're in a state of flux.
Yep.
All we're telling you is this is what is was in the press information released by the finance minister. So if we are interpreting it wrong, or if they've put it up there wrong, well, things could be different. But the bottom line is you're right. If you don't have a deal in place, then you're going to be under the new rules. It's pretty much as simple as that.
And the whole purpose of the new rules, as far as I can tell, is just to cool the market off. What they're trying to do is preemptively say mortgage money right now, borrowing money is cheap. 2%, 2.5% for a mortgage is a hell of a deal. They're telling people that, well, you need to be prepared for mortgage rates to be double that, 5%. I, for one, don't see them going to 5% in the next couple of years. But
but in effect, they've already done that by saying, here's the 5-year posted rate that you have to match, 4.64%, or that's you have to qualify under. So you don't have to pay that interest rate, but you have to qualify for it. So it's almost as though interest rates have gone up by a couple of points immediately.
And that's gotta throw water on the market. It's gotta cool things off.
Well, and also it means that the pre-approval that you got may not be worth the paper it's written on.
True.
Because it's under the old rules. If the deal hasn't been consummated, then you've got a problem. So if you haven't locked it in, that could be. So I think there's going to be certainly some deals that don't close.
Yeah, there's going to be fallout.
There's got to be. There's simply got to be fallout. So, okay. So speaking of fallout, but we're talking about, is the sky falling? So, what does this all mean? Where do you see this all going?
Well, okay. So first and foremost, it means first-time home buyers, young families, new Canadians, people getting into the market for the first time, are going to be delayed their entry to the market, or they're going to have to revise their housing expectations. They were thinking about moving into neighborhood A, and now they're looking at neighborhood B or simply a lower value property because they won't be able to afford the payments. The second thing, of course, is people looking to sell their homes are probably looking at lower prices. If there are fewer people that qualify to buy, particularly the lower end of the market, the first-time home buyers, then the prices for those properties are going to drop, or at least they're certainly not going to climb the way they have been in the last few years. So it's going to impact people across a range of things. The part that scares me the most is Canadians have been increasing their debt based on the equity in their homes because mortgage rates are so cheap. This is effectively going to have a negative impact on housing values, in my opinion, which means it's going to have a negative impact on all the levels of debt that people have been carrying and the plans that people have made. So there's going to be fallout.
Yeah, and I guess what kind of gets to me is, why are we having this discussion? Why is it that the federal government guarantees mortgages? Because the rule is, if you have less than a 20% down payment and you are getting a mortgage from a federally regulated lenders, so we're talking about the big banks, then you must have mortgage insurance. Canada Mortgage and Housing Corporation, CMHC, is the biggest insurer. Obviously, we talked about a couple of others. CMHC is a government agency. Ultimately, it's backstopped by you and me, the taxpayer. So, you've got the big banks who, if a mortgage goes bad, can in effect go to the government and say, hey, make me whole. Now, the biggest bank is, I'm not going to mention their name, but their initials are RBC. And when you look at their financial statements for the most recent quarter, their net income was a record almost $3 billion. So that's almost $1 billion a month, $1 billion a month that the biggest bank makes. Obviously, the other banks also make tons of money. So is it really necessary for the federal government to protect the big banks that earn huge profits from loan losses? I mean, doesn't this guarantee simply cause the big banks to lend more money on high ratio mortgages to heavily indebted consumers? I mean, think about it this way. So Ted, I say to you, hey, will you loan me $1,000? And you're going to say, yeah, no, I know you. I don't trust
Can we use
you.
somebody else?
Yeah. Is there anybody else out there I could loan to? But if I said to you, wait a minute, Ted, there's this government program that will guarantee the loan. It doesn't matter. Even if I don't pay, the government will kick in the money. In that case, you'd say, well, fine, I'll loan you $10,000 then. What's the big problem?
What's the risk?
And I don't even have to worry about the interest rate. I don't have to make it a high interest rate. Let's make it 2-3%. And that, I think, in simple terms, is the Canadian mortgage market today. You know, the big banks, mortgage lenders, and even, private lenders can lend as much as they want at very low interest rates to less than perfectly qualified borrowers, because if there are any losses, the taxpayer is going to cover them. So, I agree that the Toronto market's crazy, and it would be nice to tamp it down a little bit to make things a bit more affordable. But is the solution for the government to say to the big banks, we're not going to cover for you anymore. If you lose, cover your own losses? Wouldn't that be a better approach than what we got now?
Well, it would certainly tighten up money. I think we need to be very, very clear about how the mortgage insurance works. You certainly described it properly, but I'm not sure everybody understands this. When you get mortgage insurance, it's not for you. It is for the lender. So if you default on the mortgage, the lender gets their money back. That's exactly what you were just saying, but I'm not sure everybody fully appreciates that. They think that when they're getting mortgage insurance, it's covering them. It is not. So typically what happens if you unfortunately lose your home, the bank will take your home from you, sell it, make a claim against you, and then they'll immediately turn around to the insurer and make a claim against them. They get their money back. That's what you were just saying, so they're not at risk. The insurer then has the right to come after you for the money that they had to pay out on the policy. So eventually, and this is often 3-4 years down the line, CMHC or Genworth or whomever provided the insurance is going to come looking to you for that money. Mortgage insurance is not what people think it is.
Yeah, we think of insurance like car insurance. So if I'm in a car accident and my car gets wrecked, the car insurance company, my insurance company will pay me. Right. Here you go. Here's the money. I am insured. But in this case, if my house gets sold and the bank loses money, I don't get the money. The money goes to the bank. It's insurance for the bank.
It's a little crazy.
And you and I over the years have done many, many bankruptcies and consumer proposals for people who did lose their house. And you're right. It's always years later that CMHC's coming after them.
Yep. It doesn't make any sense to me. That's just the business model that they follow.
I think the record I've seen was 10 years later.
Yeah.
It took them 10 years. They start by taking your tax refunds and everything. But if they don't recover it fully from you, then ultimately it's the taxpayer that's covering it. So to sum this up, let's talk about the future and let's give some practical advice here. So I think you've already kind of hit on it, but how do you see this affecting borrowers and the real estate market in general? And I know we're not real estate professionals, so we're guessing here, but how do you see the future?
So first and foremost, I see this slowing down the bottom end of the market significantly. If the lenders are correct, then a third of all people that qualify for mortgages are going to be in trouble based on these new policies. That means it's a third of people that won't be in the marketplace. So that's going to have downward pressure on prices, and it's going to, it's going to do funny things to the market. Now, what can you do from a practical standpoint to make sure you're safe? Well, the best way to buy a new home is to not have to buy mortgage insurance at all. So to have 20% down. That's just not realistic for most young Canadians or new Canadians. Many people are still buying properties with 5% down. And that's just a risky way to buy a house because you are so leveraged, you're so influenced by what happens with the interest rates. Any kind of upward pressure on interest rates, they go up, your payments go up, and that can affect your ability to make the mortgage payment. That, of course, is the underlying premise behind why the government's doing this. They're trying to make sure that if the interest rates do go up, you will still be okay. It's kind of a backwards way to do it.
And I'm a bit of a conspiracy theorist. I don't know. Is that really why the government's doing it, or are there other reasons? I mean, you're right. The average detached house in Toronto now costs $1 million or whatever.
Yeah, which is crazy.
Who at the age of 25 can come up with $200,000 for a down payment? I mean, it is impossible in most cases,
right?
Unless you've got rich family or whatever. So I fully understand why people are getting mortgages with 5% down. They don't have any choice.
Yep. And that's still $50,000 on $1 million house. So that's still a lot of money.
It's still a huge amount of money. So, I mean, I worry about this. So you've got this new insurance thing now, and the mortgage brokers are freaking out.
Yeah.
And there are a lot of companies other than banks that give mortgages. We've got what they call the monoline lenders. So these are companies that just do mortgages. They don't do line of credits, bank, credit cards, bank loans, anything like that, like the banks do. Do you see them being even more squeezed as a result of this?
Oh, definitely. So someone who only does mortgage business, and there's an impact to a third of the people applying for mortgages, is going to take a hit on their top line and their bottom line. It's going to make it much more difficult. I predict that some of these players will probably leave the marketplace. They'll just go. And so that means there's less choice for consumers. There's less competition for your mortgage dollars, which puts the multifaceted lenders, and we're talking about the big Canadian banks here, in a better position. The fewer alternatives you have to borrowing from a bank, the better the bank's position to be lending you money.
So if I can quote you here then, what you are saying is these new rules are going to help the big banks.
I don't see how they can't help the big banks because the banks have so many different facets, different income streams. A company that only lends for residential mortgages is now going to take a hit because there'll be a third fewer mortgages written.
And if those, and you already sort of made a prediction here that some of these monoline lenders and probably some mortgage brokers as well end up going out of business as a result of this,
right? Or
leaving the market. Well, if I'm the guy left in the market, I'm in a better position then.
Sure. And so I don't have to be as sharp with my pencil. I mean, we said earlier, it's kind of a throwaway comment. When you see the advertised rate for a mortgage by a bank, you go in and say, look, I've been a good customer. I want you to take something off. Most banks, at least in the past, have been in position to shave off a quarter point or maybe a half a point. Now, at current rates, a half a point might be difficult, but you can get something. You can get a better deal. Well, the reason they have to do that is because they're competitors in the marketplace. There are other people that are willing to lend you money at that better rate. The fewer people there are competing with the lenders, then the less sharp their pencils have to be, the less inclined to give you a great deal.
Yeah, so if the posted rate right now is 4% and they know you could go to some other competitor and get it for 3.5%, well, they're likely to match it or lose your business. But if there are no other competitors, if the only competitors are the big banks, then that puts them in a great position. So,
Exactly.
So there you go. There's the conspiracy theory. You know, did the big banks go to the government and say, hey, look, we want to, take a run at us, put these stress tests in, which makes it looks like you're hurting us, but really what it's going to do is hurt our competitors even more.
Yeah, I'm sure I read that someplace in all the analysis we did for this, that the 5 big banks actually approved of this concept. So
yeah, and of course I'm sure they won't admit that, but that's probably
a different
the case.
issue.
So back then, to wrap this up to the actual person who's listening, you said number one, as big a down payment as possible.
Always.
What else should you be thinking about before you buy a house?
Well, from a practical standpoint, it's going to cost you more to own a home than to rent a home. And the rough guideline I always use, it's like 125%. So whatever your rent was for a comparable space, figure that your owning costs will be at least 125% of what your rent used to be. So if you paid $1,000, it's going to be $1,250. And the reason for that is you now own the property. You're responsible for maintenance, repairs, upkeep. Something is always going wrong when you own a house. Or for that matter, your spouse just, you want to paint the rooms this year because they don't look nice. You need to put new trees and shrubs outside. New
carpet, all sorts of stuff.
Now the neighbor's kid smashed your window or something. I mean, there's always something that happens that's going to cost you more money than when you are renting. So you got to be ready for that.
And if the cost of a mortgage ends up going up as a result of this, that's another cost. So,
Yep.
So the practical advice then is have as big a down payment as possible.
Right.
And who knows, if the real estate market does go down as a result of this, for people who haven't yet bought a house, this may actually help.
That's true. I mean, so if you know that you're in the market and you've been looking at something, you want to get a deal done, well, get it done before October 17th so that you can have the new rules waived. But if you're sitting on the sidelines thinking what could happen, well, I predict this will put downward pressure on prices.
Yeah.
So it might be better to sit on the sidelines a little longer, increase your deposit, your down payment, and you might be in a better position.
Yeah, I mean, we're moving into the slower period for real estate now anyways.
Right.
Obviously December, January, February are slow months. So if it's slower from that point of view and you've got fewer buyers, then it's quite realistic to expect that house prices could be lower in the winter and the spring. Now, of course, we don't know. They could be higher. So
Right.
you gotta make your own decision. But okay, so as big a down payment as you can, obviously saving money before buying. Probably don't be jumping into any deals unless you can do them in the next week or so. Otherwise, it'll probably be cheaper in the future, although...
Well, you know what's funny? There will be real estate agents that use this to pressure people to get a deal done in the next 2 weeks. So don't sign anything you're not fully prepared to do. Like, it's a pressure sales tactic, right? Oh, the rules are changing October 17th. We better get this deal firm by October 16th. Be careful.
Yep, limited time only. So there you go. There's some practical advice, and there's our view on how this is all going to pan out. We don't know for sure, but I'm sure we'll be talking about this over the coming months. And as always, we'll have lots of information on this on our website at hoyes.com. That's HOYES.com. That's our show for today. Thanks for listening. Thanks for being here, Ted. Until next week, I'm Doug Hoyes. That was Debt Free in 30.
Thanks for listening. That was Debt Free in 30.